Let's be honest. One of the most debated financial questions out there is this: should you rent, or should you buy a home? On the surface, it seems like a simple comparison. Renting feels like throwing money away, while buying a home feels like building an asset. But when you dig deeper, the truth is far more complicated, and the answer isn't the same for everyone. Think about it. When you rent, your only expense is the rent itself, the money you pay your landlord every month that you'll never see again. For example, if your rent is $2,000 per month, that adds up to $24,000 a year that's simply gone. That money didn't build equity, it didn't go into savings, it just left your pocket. Now, homeownership is a little trickier. Yes, you make mortgage payments, but that's only part of the story. Owning a home comes with several additional costs: property taxes, maintenance expenses, and the interest portion of your mortgage. These are also expenses you don't get back. So, to fairly compare renting and buying, we need to calculate the money you never recover in both cases. That's the true cost we're trying to evaluate. This perspective isn't entirely new. It was popularized by Ben Felix, a Canadian portfolio manager, who introduced something called the 5% rule. His explanation helped people view the rent versus buy debate from a more analytical angle. But here's the catch: that was years ago, when mortgage rates were much lower. Fast forward to today, and interest rates have surged, now hovering around 6.5% to 7.5% for many borrowers. With rates that high, it's time to revisit the conversation and take a fresh look at how things stack up in today's housing market. At the core of this debate is a key question: what's the true monthly cost of homeownership? Once we can measure that, we can compare it directly to monthly rent and determine which option makes more financial sense. If owning costs less than renting a similar property, then buying might be the smarter move. But if renting is cheaper, it could still be the better financial decision. So, what exactly makes up the cost of owning a home? There are three main components: property taxes, maintenance expenses, your mortgage payment. Each one represents money that leaves your pocket without directly increasing the value of your home. Renters don't have to worry about these costs, which is why this breakdown matters. Let's start with property taxes. Every homeowner has to pay them. The government charges you a percentage of your home's assessed value each year. In the US, the average residential property tax rate is about 1.11%. To keep it simple, let's use a $500,000 home as our example. At that rate, property taxes would total $5,550 per year, money you're required to pay, but will never get back. Next, we have maintenance costs. Homes need care, repairs, updates, and general upkeep. Experts usually recommend setting aside 1% to 2% of your home's value each year for maintenance. If the home is older, that number might go up. But let's stick with a conservative 1%. On a $500,000 home, that's $5,000 annually just to keep everything in good condition. Combined with property taxes, you're already spending between 2% and 2.11% of your home's value each year on non-recoverable costs. Now, let's talk about the big one, the mortgage. This is where things get more complex. Typically, when you buy a home, you put down a 20% down payment. For a $500,000 home, that's $100,000 up front. The remaining $400,000 is financed through a mortgage, usually over 30 years, which is the most common loan term. Here's the catch: there are two separate costs tied to your mortgage. The first is obvious: the interest you pay on that $400,000 loan. The second is less obvious, but just as important, the opportunity cost of your down payment. That $100,000 could have been invested elsewhere, like in the stock market, where it might have grown over time. And this is where the debate heats up. Historically, the stock market has outperformed real estate. If you look at the S&P 500 over the past 30 years, the inflation-adjusted return has averaged around 7.19% per year. Meanwhile, median U.S. home prices during the same period grew by about 1.97% annually after inflation. That means, on average, stocks outpaced real estate by about 5% each year. So what does that mean for your $100,000 down payment? If you had invested it in stocks instead of tying it up in a house, it might have earned an extra 5% per year compared to the return from home appreciation. That lost growth is a real cost, even if you don't see it as a monthly bill. It's called opportunity cost, and it's a crucial part of the rent versus buy calculation. Of course, this doesn't mean every renter takes their extra cash and invests it perfectly. People are human. Sometimes, instead of investing, they spend it on travel, lifestyle upgrades, or just everyday expenses. That's why theory doesn't always match reality. But from a purely financial standpoint, the math is clear. When you put money into a down payment, you're giving up the potential returns that money could have earned elsewhere. So, let's recap. Homeowners face 4 key costs: property taxes, maintenance expenses, mortgage interest. Opportunity cost of the down payment. Renters, on the other hand, just pay rent. So the real question becomes, does buying actually save you money in the long run, or does renting leave you better off financially? We'll plug in some real numbers shortly to make this more concrete. But pause for a moment and consider this. Most people assume owning is always the better choice. But when you break it down, it's not that simple. With today's higher mortgage rates, the scales are tipping in ways many people don't expect. And here's the thing. While property values might rise, and while owning a home can feel like a safe long-term move, the hidden costs of ownership quietly add up. That's why this comparison is so important. Because we're not just asking, do you want to own or rent? We're really asking, where is your money working hardest for you? Stick around, because in the next section, we'll dive into the exact numbers, run the calculations step by step, and uncover how these hidden costs shift the balance between renting and buying. Earlier, we broke down the hidden costs of homeownership, property taxes, maintenance, and the opportunity cost of your down payment. But there's still one more key piece to the puzzle: the cost of debt, or more simply, the interest you pay to the bank each year. Think of it this way: the bank isn't lending you hundreds of thousands of dollars out of generosity. They're charging you for the privilege of borrowing that money, and that charge is your interest rate. And right now, interest rates are no joke. To keep things simple, let's say you're paying about $28,000 per year in mortgage interest. We'll calculate it the straightforward way. Take the outstanding loan balance and multiply it by the interest rate. That's not exactly how banks calculate interest, but it gives us a clean, conservative estimate to work with. So when we talk about the total cost of capital, we're really combining 2 elements. The opportunity cost of the down payment, we estimated this at 5% of $100,000, or $5,000 per year you're potentially missing out on. The interest paid to the bank, around $28,000 per year. Add them together, and the total cost of capital is $33,000 annually. Now, let's express the cost as a percentage of the home's value. Take $33,000 and divide it by $500,000, and you get 6.6%. In other words, 6.6% of the home's value disappears every year in unrecoverable costs. Let's bring everything together: property taxes, 1.11% maintenance, 1% cost of capital, 6.6%, add them up, and you get a total annual ownership cost of 8.71%. This 8.71% figure becomes a powerful shortcut, a simple rule of thumb for estimating the yearly cost of owning a home. All you have to do is multiply the home's value by 8.71%, then divide by 12 to get your monthly ownership cost. Let's run a quick example. Say you're considering buying a $400,000 home. Multiply that by 8.71%, and you get $34,840 per year. Divide by 12, and you get about $2,903 per month. That's your all-in monthly cost of ownership, not just the mortgage, but also taxes, maintenance, and the opportunity cost of lost investment returns. Here's where it gets interesting. If you can rent a comparable $400,000 home for less than $2,903 a month, then from a financial perspective, renting comes out ahead. Your monthly outflow is lower. But if rent is higher than that figure, then owning might make more financial sense. The 8.71% rule is quick, easy, and surprisingly insightful. With just a few basic numbers, you can get a clearer picture of whether renting or buying is the better financial move. It cuts through the noise and removes a lot of the guesswork. But before we treat this formula like the ultimate answer, we need to talk about its limitations. Because as useful as this shortcut is, it's not perfect. And if you don't understand its flaws, you could draw the wrong conclusions. First, there's the issue of human behavior. The rule assumes perfect rationality, that if you don't put your $100,000 into a home, you'll invest it wisely in the stock market and earn a steady 5% return every year. But let's be honest, most people don't operate that way. Instead of investing consistently, some spend impulsively. Maybe that money goes toward a new car, a luxury vacation, or simply gets eaten up by lifestyle creep. Even with good intentions, investing takes discipline, and not everyone has it. So it depends heavily on your specific tax situation. The standard deduction for individuals currently falls around $13,000 to $14,000. If your annual mortgage interest is less than that, you likely won't gain much from itemizing. But if you're paying more, say $15,000 or higher, then deducting that interest could significantly reduce your taxable income. Still, the exact benefit varies based on your tax bracket, loan amount, and interest rate. So while this deduction can lower the real cost of owning, it's not a guaranteed perk for everyone. You'll need to run your own numbers to see if it helps you. Now, beyond spreadsheets and percentages, there are real-world benefits to owning a home that can't be measured with math alone. First, predictability. With a fixed-rate mortgage, your monthly payment stays constant for the life of the loan. You know exactly what to budget, year after year. Renters don't have that kind of stability. Landlords can raise the rent with each lease renewal, and sometimes the increases are steep. Then there's control. Want to repaint the walls, remodel the kitchen, or build a deck in the backyard? As a homeowner, you can, no permission needed. Renters, on the other hand, often have to ask for approval or settle for living with choices someone else made. And let's not forget security. You're not at risk of being forced out because your landlord decides to sell the property or not renew your lease. As long as you pay your mortgage, the home is yours. Another overlooked benefit. Inflation actually helps homeowners. That might sound counterintuitive, but here's why. Your mortgage payment is fixed, while the value of money decreases over time. Imagine if you locked in a $300 mortgage payment 50 years ago. Back then, $300 was a significant sum. Today, thanks to inflation, that same $300 feels like pocket change, yet your payment hasn't changed. While 50-year mortgages don't exist, a 30-year mortgage still gives you a taste of that benefit. Over time, inflation makes your fixed monthly payment feel smaller compared to your rising income and living costs. And of course, there's the big one, capital appreciation. Home values often rise over time, and in some cases, they rise a lot. Take this real example. A home purchased for just under $600,000 in the mid-1990s recently sold for over $3 million. That kind of appreciation far outpaces national averages, but it shows what's possible. While not every property experiences explosive growth, the potential for long-term gains is one of the biggest reasons people choose to buy. That said, renting has its own legitimate advantages, and they shouldn't be ignored. Flexibility is a big one. Renters aren't tied down. If you want to move to a new city, switch jobs, or explore a new lifestyle, it's much easier to break a lease than to sell a home. Simplicity is another. Renters don't have to worry about property taxes, emergency repairs, or ongoing maintenance. If the roof leaks or the furnace breaks, it's the landlord's responsibility. As a renter, you typically just pay your rent, and maybe a small amount for renter's insurance. And then there are the amenities. Many modern rental buildings, especially in urban areas, come with perks you wouldn't find in a typical single-family home: on-site gyms, swimming pools, rooftop lounges, community workspaces, even concierge services. For renters, those extras are often included in the rent. For homeowners, they would either cost extra, or be out of reach entirely. So where does all of this leave us? The truth is, there's no one-size-fits-all answer. Renting and buying both come with unique financial trade-offs, lifestyle benefits, and long-term consequences. The right choice depends on your personal situation, your income, your money habits, your career plans, family needs, and even your comfort level with financial risk. That's why the most important thing you can do is run your own numbers. Use the 8.71% rule as a starting point, then adjust for your local property tax rates, interest rates, and maintenance expectations. Factor in how long you plan to stay, your ability to invest, and the stability of your income. When you take everything into account, the picture becomes much clearer. Here's the bottom line. With today's high mortgage rates, renting may often seem more appealing in the short term. For people who aren't sure where they'll be in a few years, renting can save money and a lot of stress. But if you're planning to stay put for 5, 10, or even more years, buying can offer real, long-term advantages. You lock in your housing costs, build equity, and gain a shot at appreciation that renting simply doesn't provide. Ultimately, this decision isn't just about dollars and cents, it's about peace of mind, freedom, stability, and lifestyle. The math helps give you clarity. But your values, goals, and habits give you direction. So whether you choose to rent or buy, make the decision with your eyes open, fully aware of the trade-offs on both sides. That way, no matter what you choose, you'll know it's the path that aligns best with your financial future and the life you want to live.